Hi, I'm Juliet Schooling Latter from Chelsea Financial Services, and today I'm talking to George Cooke, manager of Montanaro European Income. George, thank you for joining me.
Thank you.
Dividends, or rather dividend cuts, are rather a worry for income investors at the moment. So perhaps we can start with your views on the outlook for dividends in your fund and the wider market. I noticed, for instance, that your second largest country allocation is to France, where there's been almost a blanket ban on dividend payments by the government.
Yes, and so we do expect dividends to fall this year. But I think, as you sort of alluded to there, this is as much political as it is anything else. So we have companies that have got net cash on the balance sheet, which sort of the fundamentals of those businesses are holding up pretty well, and yet they are cutting or postponing their dividends. For political reasons, because they've essentially been told, it's not a good look to be taking government support schemes while at the same time paying millions of pounds out to shareholders. Now, we do expect some of our companies that cut this year to actually pay specials in later years and essentially therefore make up for it in the future. And I think it's not an entirely unfair trade-off, really. I mean, some of these government support schemes are really helping to protect profitability. And I think the furlough schemes in particular are giving companies really the best of both worlds when it comes to an ability to rapidly cut costs in terms of staff without losing that ability to rapidly recover when things do turn. And so what we're focusing on primarily in this environment is the ability for these dividends, firstly, to bounce back once the sort of political pressures do abate, and then to see sustained growth going forward. And for that, you need strong balance sheets, good mid to long-term structural growth prospects, and if we can combine that with market-leading positions where some of the competitors might actually be weakened by what we've seen, then so much the better. I guess if we look at the wider market, we try not to take a big view as to what happens in the wider market. We just focus on the companies we invest in. But what we can say is that on average, our companies have stronger balance sheets, they've got better returns and higher growth prospects than the average company in Europe. And so that gives us a bit of confidence that when things do gradually return to more normal, that we can start to see an attractive dividend and an attractive growth profile in those dividends as well.
Thank you. And did you make any sales or acquisitions during the market sell-off?
So we generally have a low turnover approach. So we would not usually expect to be making sort of lots of major changes to a portfolio, really in any circumstance. And experience has taught us that knee-jerk reactions often prove to be wrong a year or two down the line. So we try to really take a considered approach to this. Now, when things really started heating up, what we did was we went through the portfolio stock by stock, just rechecking the liquidity, the balance sheets, the dividend cover, both earnings and free cash. And then we spoke to the companies themselves just to see, are there new areas of threat, given this is quite a unique situation that we find ourselves in. On the back of that, there was one sale from the portfolio. So we sold a company called GetLink, which I think most people would know it by the name Eurotunnel. Now that had the most stretched balance sheet in the portfolio. I have to say most of our companies have very, very solid balance sheets. So to say it's the most stretched doesn't necessarily mean it was stretched by sort of normal standards. But we felt that in light of the kind of the very, very significant and really unprecedented hit to passenger numbers and to earnings, that they could face covenant breach there, depending on how things played out. Now, it was a bit, it wasn't guaranteed. We weren't sort of sat there saying, yes, it's definitely going to hit these covenants. And of course, we don't know if those covenants would be waived or so on and so forth. But we're just allergic to kind of balance sheet risk. So as soon as it becomes even a question mark, we seek to exit. And so that we sold it that same day. Now, the good thing about our process is that we always have a sort of backup list of good quality companies on the sidelines. And of course, when we see a market rout like we did, that gives us an opportunity to sort of pick up other positions which have perhaps been a bit unfairly hit. So we managed to do that. But I think mostly actually where most of the sort of the inflows and so on went was actually into existing positions, because that's where those are the companies we know the best. It's where we can have the conviction and we kind of know the management teams and so on there, and we know the business model. So we should be relatively secure in the knowledge that these are good quality businesses with good growth prospects. So I think for all this talk, though, of things that we've done, for the sales and the purchases and so on, we really haven't had to do very much, and our turnover is still very low because our style, which is focused on high quality and growing businesses, that's just the best place to be when the economic environment deteriorates. So frankly, we just take the view that if it isn't broke, don't fix it. And so the portfolio is in really very, very similar shape to the portfolio at the end of last year.
And what are the companies telling you now, as some countries are sort of in the process of relaxing lockdown?
Yeah, well, it's really it's a very mixed picture because companies have been affected in vastly different ways by the lockdown. I mean, if we take a company that we own, Avanza. They're the leading savings and investment platform in Sweden. They're kind of analogous to a Hargreaves Lansdown in the UK. Now they're ramping up their investments as hard as they can because they've seen such strong demand in this period. I mean, their net inflows in May were more than 140% higher than in the same month last year. So for some companies, it's really a case of how do we deal with the demand that we're seeing. That is not the case across the board. So for other companies, and I would pick the example here of Thermador. So they're a wholesale distributor of plumbing supplies in Europe. Now, in April, they said, we hope to see sales in May that are only 60% of the level in 2019. So they were hoping that the drop in sales would be limited to 40%. But then later on, a month or so down the line, they actually revised that, having worked their way through May, they revised that and said, we think it's going to be 75% of the sales of last year, so a 25% drop. So as those confinement measures eased, it does seem like, maybe we're through the worst of that impact, and the companies tend to be sort of better than they might have expected when we were really at the worst point. I'd hasten to add, though, I think one thing we to really try not to do is to get too focused on the very short-term picture here. I think, we're long-term investors. So when we speak to companies, we're really asking them about how this will affect their operating environment over the next 3 or 5 years, because that's what's going to determine the long-term returns. And so that's what's really going to matter to us.
We mentioned a couple of companies, but lots of the companies in which you invest in won't be familiar to our viewers. Are there a couple of your favourites you'd like to share with us?
Sure, I can talk about companies till the cows come home, but I guess to pick up a couple of certainly the lesser known stocks, I mean, one of our companies called Mention Machine. It's actually an 800 million euro market cap business, but I think very few people have ever heard of it. It's German, still run by the founder and the CEO, Adi Drotlev. And he and the management team, this is one of the things we really like to see in our companies, they own more than half the company themselves. So they're very well aligned to the shareholder base. And the company, so that they make computer-aided design and manufacturing software. So it helps you to build a virtual model of a component that you might want to make. And then it tells the CNC machine, for example, how to make it. So one of the examples they give to show sort of how good this software is, there was a well-known car company who were making an engine component, and it was taking them about 3 hours to make this engine component on their CNC machine. And when Mensch came in and said, why don't you try our software? They brought that 3-hour time down to 2 minutes. So you can see that the sort of return on investment of a bit of software like that is really very big. The other sort of interesting thing about Mention and this environment is that one of their biggest barriers to sales, and they've been saying this for years since we sort of owned them, is actually just getting time with the customer and getting time to prove what their software can do on the milling machines. Because when the economy's booming, you don't want any downtime in your milling machine. So when the Mensch salesperson comes and says, "Can I show you what we can do?" The answer is sometimes no. And so now things are slowing down somewhat. Ironically, that actually is not a terrible opportunity for Mensch, and they might be able to get a bit more sort of time in front of the customer. I should say they're also the largest value-added reseller of Autodesk software in Europe. And while that's a smaller part of the business in profit terms, it's still a nice, steady, growing business, and it has some synergies with the other parts of the business too, because Mensch can provide kind of bolt-on modules to that software. So this is a business which, despite everything that's happened, they are still expecting to grow their net profit by between 18 and 24% this year. In the next few days, they'll be paying out a dividend, which is 30% higher than it was last year. And they've already guided that next year they expect to see the dividend go up another 20%. So it's a very attractive business, both from a growth perspective, but also from a dividend perspective as well. I guess maybe the second example I'd highlight would be Medistim. So this is a Norwegian company, and if we put it into euro terms, it would have a market cap of about 375 million. So again, a smallish company in the scheme of things. And they make systems and probes which are used to measure and visualize the flow of blood when a surgeon is performing heart bypass surgery. And so by being able to measure and see the blood flow in a bypass, it means that if there's a problem, the surgeon can kind of stop and fix them there and then, which is a lot cheaper than realizing there's a problem after you've sewn them back up and they've gone home, at which point you have to bring them back and things get very, very expensive. Now, the alternative to using a Medistim product, and rather scarily, the most common practice still in many markets, including the UK and the US, is for the surgeon to literally use their finger to feel for blood flow and to say, yes, okay, there's blood flowing through the bypass, that will do. Now, clearly, that's quite a scary thought to begin with, but there's a large amount of clinical evidence now showing that Medistim's product not only improves patient outcomes versus using the fingers, but it actually saves the healthcare system money as well, even including the cost of the system itself. So it's quite a compelling proposition. Now, Medistim, they're the market leader, the dominant market leader in this space, and there are quite a few nice sort of structural growth opportunities for them. So I mentioned the US earlier. Something like a quarter of the surgeries in the US use this system. And that would compare to something like 70 or 80% in the Nordics or Germany or Japan and so on. So there's a large penetration opportunity there, and also in some emerging markets, particularly China. They then have a further opportunity in expanding into the vascular surgery segment. That's another 1 billion Norwegian kroner market opportunity, which they've begun to develop, and so far that seems to be going quite well. And then there's an opportunity in that a lot of their customers still only use the flow measurement product, and the visualization product, which is newer. Is something that Medistim are now trying to get the flow measurement customers to use the visualization one too. So quite a few different growth drivers. The probes themselves, because they're disposable, they provide a nice kind of recurring revenue stream. But we should say that even this business is likely to be impacted in the second quarter, particularly because we have seen surgeries be postponed because the hospitals are sort of almost exclusively dealing with the COVID threat. But of course, these operations, they can't be put off forever. If you need a heart bypass, you can't really wait for years and years to have one. And so we've got reasonable confidence that things will bounce back quite quickly once the sort of peak of the threat has passed. This is an example of one of the companies that I sort of alluded to earlier, where they've suspended the dividend at present, so it hasn't been formally cancelled, but at the same time, what they've said is, the board has authority to pay it, but they will make that decision as to whether they will or not at a later date once things have kind of settled down. But they do have net cash on the balance sheet, I think a pretty solid business model as well. And so I think the sort of prospects of that business 5 or 10 years from now are really as strong as ever. And I think if we look to history as well, it shows you why we mustn't sort of miss the wood for the trees, because in 2006, so before the financial crisis, the company was paying out a 27 cents per share dividend, and the proposal for 2020 was 2.75. So that's more than a 10 times higher dividend in that period. So we're not going to worry too much about a single year, and quite an exceptional year, as long as we can see that kind of longer term growth trajectory is remaining strong.
And I notice your fund fact sheet includes a carbon intensity and a water intensity figure for the fund.
Yeah.
Wondering what the significance of this is for investors and how long it's been monitored on the fund.
Yeah, well, this fund, even though it's not marketed as an ESG fund, we do have exclusions on companies that have sort of negative effects to society. So companies involved in tobacco, gambling, weapons, and so on and so forth. And so many of our clients actually do use it in their ethical portfolios. And more fundamentally, we believe it is important to measure the environmental data of the companies in the portfolio. So since the end of 2019, we started to receive carbon and water data, and that comes from MSCI. And the purpose of that is to assess, firstly, how much carbon is produced and how much water is used by our companies in the running of their business. Secondly, which companies just aren't reporting relevant or accurate data, whether it be on carbon or water usage. And then thirdly, we can then see which companies are the outliers, and where is there therefore an opportunity to engage with them and hopefully improve the standards of their reporting and maybe even enact some sort of long-term change. So we're aiming to build this data set up over time. We want to see that sort of and monitor that long-term change across the portfolio and make sure that things are sort of moving in the right direction. And as well as just being a sort of responsible thing to do, we also believe that companies that have good ESG practices, ultimately they deliver better long-term returns in our view, and they tend to be more sort of sustainable businesses that are managed well. So it's just another part of the overall quality equation that we look for when we're investing in a company.
Thank you for chatting to me today, George. For more information on Montanaro European Income, please visit chelseafs.co.uk.